People talk about ROI like it's just a spreadsheet formula, but in business buying, it's also a freedom formula. Today, I'm going to dive into what an ROI is and why it's important. Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it. If you're in your 20s or 30s or in your 40s, you've probably heard people say, work hard, save your money, put it in a retirement account, and in 20, 30, 40, 50 years, you'll have enough to actually retire. But why wait 30 years? Why wait 20? Why wait 40? And is your job really all that stable? Or given especially the state of the economy today with layoffs and AI, are you secure in that job? Are you going to be able to save for another 20, 30, 40 years to actually hit retirement? That's where the question of are you getting a good ROI or return on investment comes into play. When you're taking your money and putting it into the stock market, putting it into your 401k, or actually I should back up. If you're taking your money and putting it into a 401k, first of all, are you even investing that money within your 401k? 401k or any retirement vehicle or any kind of brokerage account in general is just the first step of putting your money somewhere that it can be invested. I was just talking to somebody the other day who mentioned that she's putting money into her 401k, which she doesn't even know if it's being invested. That can be a huge negative implication for you in the long term, since that money is not actually making you any more money. The purpose of putting it into a vehicle like a 401k is so that it makes a return. You are investing that money into usually the stock market so that it can give you money back. It can grow over time. It gives you a return on that investment. So when you are looking at any type of investment, you need to know what your return from that investment is going to be. That is what the ROI is, return on investment. It's kind of like a scoreboard for how well your money is doing for you. So for example, if you invest $100 and you make $10, that is a 10% return on your investment. You divide that 10 by the 100 to get a 10% return on investment. That in and of itself does not tell us much. You kind of need to know what's a good ROI and what's a bad ROI. And this is where I referenced at the beginning that it's not always just about the dollars and cents and the percentage that you can calculate in the financial terms. There are other elements to an ROI, especially in considering a business acquisition, that come into play. Today, we're going to kind of dive through some of those at a high level and a little bit more granular as well. So on a high level, very broadly with a small business acquisition or kind of in general, your ROI is going to be the annual profits that you get plus your equity growth in the company divided by the total investment you made in the business. So, for example, if you buy a business for $200,000, and it doesn't matter how you finance that business, if the cost is $200,000 and you make a profit of $100,000 and the business went up in value $10,000, your total return for the year is $110,000. You divide that by 200,000 and you get a 55% return on investment, 55% ROI. Is that good? Bad? Sounds pretty good. That's much better than a stock market. But there are other factors that come into play that we'll get into in a minute. As a total project, that was a 1-year calculation of ROI. You also want to kind of look at the total project, the total life of the investment to calculate an ROI. So that same business, if you hold that business for 10 years, and we'll just for simplicity's sake say that the profits stay $100,000 per year. So you have $100,000 times $10 million plus that $10,000 gain in equity every year. Again, for simplicity, we're going to keep that the same. Things rarely work out that way in life, but it might go up faster. It might compound 10% on 10%. So, but again, simplicity. So our total return with that $1 million of profit over 10 years and that $100,000, that $10,000 a year equity gain is $1.1 million. So that is our return on the $200,000 investment. So that 1.1 million profit divided by the $200,000 initial investment in the business would give you a ROI of 550% over that 10 years. Now, there are some more complex formulas for taking into consideration the time value of money, because a dollar today is worth more than a dollar tomorrow for lots of reasons. But on a basic ROI principle, that's a 550% return on investment. Then there's another factor that I like to pay attention to a little bit more closely personally, is the cash on cash return, which is related to the ROI. You're taking your profit, but you're subtracting the debt pay down, the principal portion. So you're only looking at the actual cash that you get back from the business divided by the actual cash that you put into the business. Again, earlier on, I said we didn't care how that $200,000 purchase price was financed or if it was at all. But with a cash on cash return, that does matter. Because now if you only had to put down 10%, which would be $20,000 of cash, and you finance the rest of it, your cash, which is the bottom of that division equation, is much smaller. So if the actual cash flow that you're getting from the business is the $100,000 of profit less the debt pay down, and we'll just, for simplicity's sake, we'll call it $20,000 of debt pay down every year. So you have your $80,000 of cash. And for this equation, we are going to skip that $10,000 of equity growth because that's not cash coming back to us right now. That is future gains when we sell the business. So we have the $80,000 of actual cash coming back to us divided by the $20,000 we put into the business, which is 400% cash on cash return, is a pretty amazing return, considering that there's not many other vehicles out there that you could get that high of a return on your cash. That means for every dollar you put in, you're getting $4 back in the first year that you invested it. That's probably not a realistic scenario. Again, I'm just making up these numbers to play with here and to try to explain the concept of ROI and then this sub-concept of cash on cash return. I will use a real world example of when I bought my liquor store. So I invested about $35,000 of my own cash into the business. The purchase price ended up being about $300,000 with the inventory, and I got more than that $35,000, or actually probably right around that $35,000 back in paychecks in year one because I was working in the business. So I was paying myself, and that's about what I paid myself in that first year. $35,000 cash into me divided by the $35,000 I spent on the business equals a 100% cash on cash return. Now, technically, those paychecks wouldn't be counted as an investment return because it's money that had to be paid to somebody, in this case me, to run the business. So it wouldn't count in a traditional ROI formula. But for me, in my personal situation, I considered it a cash on cash return because it was money that was coming back to me. So it literally went right back into my bank account. Well, it didn't go to my bank account, it went to living expenses, but still, it was cash that I got back right away. So had I hired a manager from year one and paid them that much money to run the store, my cash on cash return would have been zero because I wouldn't have gotten any cash back that year because the profits that the business was making essentially going all to the debt pay down. So with the financing that I got from the store, the business generated about $40,000 in profit that year, and then probably estimated another 10% equity growth in that first year. It's tough to say exactly in a small business because I wasn't selling it right away, so there's no true valuation. But in my mind, the way the numbers looked, about 10% equity growth that first year. After the debt pay down, which was about $40,000 in that first year, I had nothing to show just from a pure investment standpoint of an ROI. However, again, like I said earlier, for my particular situation, I was considering that cash coming in the form of paychecks as my cash on cash return because it was actually coming back to me. Over time, that ROI has compounded. The business is more profitable than it was in the first year. The equity growth has been much faster, which means that if I went to sell it today, I would be getting substantially more money than I paid for it originally. And I've had years of high profits that have compounded as well. So the overall ROI will be much more substantial if I chose to sell it. And then I would also have to get into some of those time value of money equations to get a true representation. But for today, we're going to try to keep it a little bit more straightforward with just the ROI. You may have heard the terms. This is usually in like higher level private equity buyouts or corporate mergers, unlevered versus levered returns. Leverage refers to debt. It refers to using financing to make an acquisition. Like I mentioned, I used financing to buy the wine and liquor store, which allowed me to put minimal cash into the deal, about $35,000. Had I put in the $300,000 necessary to buy the store and the inventory, my cash on cash return wouldn't have been negative. It would have been very, very low. Using that same $35,000 in paychecks, my cash on cash return would have been just under 12% instead of the 100% that it was to me. Again, I know some people will harp on this in the comments that those paychecks to me are not actual returns and I shouldn't be counting them as part of the return process. But again, when you're making a small business acquisition, in my opinion, and the way that a lot of them are listed with seller discretionary earnings, adding back in the seller's salary, that salary to you as the owner can be considered cash as part of that cash on cash calculation. So with the levered versus unlevered, as you can see, the levered return there was significantly higher because of the financing. Financing plays a big part in these acquisitions. If you are trying to save up enough cash to go out and buy a business pure cash, your returns on that, or your cash on cash returns are going to be much lower, especially at the beginning. The actual ROI wouldn't necessarily change because the purchase price is what is used to calculate the ROI. And in fact, one could argue that the ROI might be a little bit higher because now you're reducing that interest expense on the P&L, which would increase your profitability. But it's not, in my opinion, it's not substantial enough of a change to do a complete cash purchase versus a levered purchase. So with a small business acquisition, there is no set ROI or cash on cash return metric that I am typically looking for. That's a common question I get of, well, what kind of returns are you looking for? Basically, for me, it will vary greatly depending on how much time and effort I need to put into it, how stable the industry is, what the track record of that particular business is, how well staffed it is, and how great of a reputation it has. The return that I would want to get will fluctuate depending on some of those metrics. I know it's kind of a vague answer, but unfortunately there is no set metric that I am looking for in a business acquisition. But just so we can compare, historically, stock markets are returning around 7 to 10% per year. It fluctuates. There are years where it's been lower or even negative. There's been years where it's much higher. So if I'm going to go buy a small business, especially if I'm going to have to do some work and have put in effort, I want my returns to be higher than that and substantially higher than that. Bonds, typically 3 to 5% per year. Definitely want a small business acquisition to be significantly higher than a bond return, because if I can get 5% pretty safely and securely, bonds are one of the safest and securest investments out there, then I need to be getting multiples of that on a small business where there's much more risk in the deal. Real estate can vary quite a bit. I've bought real estate with infinite cash on cash returns. I've bought real estate with smaller returns, and others do the same. But typical industry averages, if you're buying traditional rental with 20, 25% down, a lot of those returns are 10 to 15%. Again, real estate can be perceived as a little bit more secure and more stable depending on where it is and what it is. So preferably, I want my business acquisition to be higher than a real estate return as well. So kind of looking 20% minimum, but ideally even higher, all the way up to the infinite returns that some people are able to get. And that kind of leads into, what is a good ROI? Again, question that is asked a lot. Different people will have different opinions. And like I just said, those comparisons to the stocks, bonds, real estate are really what I'm looking at. As long as it's substantially higher than those, I would consider it good. If it's way higher than those, then it can be great. The other factor in that comes back to the time, effort, and energy that goes into the deal. If I'm going to spend, just even before the deal, hours and hours and hours doing research, doing due diligence, hiring people, vetting out vendors or customers, and my return isn't going to be substantially higher than a real estate deal or a stock, putting my money in the stock market, then it's probably not worth it to me. And this is where it comes back to the ROI is not always just about the numbers on the paper. I could be looking at a deal with 100% ROI within a couple of years, but the time, effort, energy that needs to go into that deal is so ridiculously intense that I might not find it worth it. There might also be other factors like the risk of the industry. Especially in today's day and age, AI has been radically changing a lot of things, and it not necessarily taking people's jobs yet, but things will change. Certain industries will evolve pretty quickly over the next couple of years. The historicals of a small business that you're looking to buy might show a 100, 200, 500% ROI, but if that business or that industry is going to be defunct in 2 to 3 years, it's not going to be a great return. So make sure you're paying attention to those risk factors, the time and effort factors. On the other end of that, I might be willing to take a 20% ROI on a deal that requires almost no effort or energy on my part because it's going to be simple, straightforward. It's not going to suck a lot of my time. And it's in an industry or a business that I can foresee being very stable for the next decade or two. So don't just get caught up in the spreadsheet of an ROI. There are a lot of other factors that play into that. And then I talked about using leverage, using debt before. Just want to point out, it's a great reminder that when you're looking at your P&Ls and you're looking at your pro formas for a business acquisition, a lot of times when you're looking at the historicals, the sellers are pulling out any interest expense that they had on the business. And a lot of times for small businesses that are long established, a lot of them aren't using debt at all anymore. So interest isn't even in their P&Ls. So when you go to make your pro forma for what you project to be doing the first year, 2, 3 of the business after you buy it, you're going to have interest expense in the P&L. Interest is an actual expense that shows up on the profit and loss statement and gets deducted from your net income. That's going to show your profit, your operating profit. A lot of people forget to do is factor in that besides the interest portion of your loan, you also have a principal portion of your loan payment. And that principal portion does not get deducted from your revenue as part of your P&L. It's because you get the money tax-free. You don't get to claim it as a tax deduction for business purposes. That principal needs to get paid out of your profit, which will deduct from your cash-on-cash return because that's less cash coming into your pocket. So, for example, if you look at your pro forma and you see a net operating profit of $50,000 and you're thinking, great, I'm going to have that profit of $50,000 at the end of the year. I'm going to divide that by whatever my cash investment was, and that will be giving me my cash on cash return. You have to look at your debt pay down. Look at your amortization schedule and look at how much principal will be paid over that first year. Now, if you're paying $30,000 in principal over that first year, then your actual cash that you're going to get is $20,000. The kicker is you're still paying the IRS on that $50,000 profit. So you're going to have a bigger tax hit than just that $20,000 too, which also gets deducted before you calculate your cash on cash return. Use a good CPA that can help you with that. Don't go trying to show a negative or a loss just to save on taxes. It's a terrible idea. I could probably do a whole video about that and the way that affects you as a business owner. But for now, just remember that if you're using financing to buy the business, that you need to deduct that principal portion before you go calculate your cash on cash return. Doesn't necessarily affect the ROI calculation because your ROI factors in that $50,000 is part of your total return. Even though that $30,000 is going back to the bank, your ROI is using the total purchase price instead of just the cash that went into it. Remember, ROI is not just a number. You need to factor in those other issues, your time, your effort, your energy, the industry risk, the business risk, what's going on in the community around the business. All of those things need to be factored in rather than just basing it on a pure number on a spreadsheet. ROI is an important calculation. You should be looking at it with whatever investing decision you're making, but don't just get tied into trying to hit a certain number on every investment because not all investments are created equal. Love to hear from you on what you think of ROI, what kind of ROIs you target on your investments, whether they're stocks, bonds, real estate, or small businesses. Do you have a particular number that you try to hit? Are you flexible like me? Love to hear from you in the comments. Let me know. Hit me up on Instagram at Tim T. Delaney or on Threads, which is where I've been much more active lately. And look forward to talking to you again soon. Cheers. Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.